So with that, I want to welcome Alex Morsing from Equivesto. How you doing, Alex?
I'm doing great, Craig. Thanks for having me. It's good to be here.
And you
Yeah.
want to tell us about who you are and what you do at Equivesto?
Yeah, so I'm a co-founder and managing director of Equivesto. Equivesto is a new equity crowdfunding platform operating in Canada. We help startups and small businesses raise funds from their own community through direct investment, with the minimum investment from an individual starting as low as $100. This is also a great opportunity for members of the general public to invest in great and exciting small businesses and startups that they wouldn't normally be able to invest in or support.
Great. Now over to you, Alex.
Perfect. Thanks, Craig. So today we're talking about how to become a startup investor. And just to frame this a little bit, I'll be talking about becoming a startup investor specifically in Canada, and how regular individuals can become a startup investor. These are the different topics that we're going to cover. When we look at investing in startups, traditionally it was something that was restricted really to high net worth individuals. So the rules in place before 2016 in Canada essentially limited investment in startups to individuals who are called accredited investors. They're also called angel investors, and they do angel investing. And with accredited investors, usually the minimum investment in a startup is $25,000 or more. And to become an accredited investor, you have to prove at the time of making your investment that you have over $1 million in net worth, excluding your house, or you're making over $200,000 a year. And so most individuals don't actually fall in this category. You could have also invested before if you were a direct friend or family member of the founder of the company, but this is usually a very small group. So there's not many people who happen to directly be related to whichever company that you might want to invest in. So before 2016, those are really the only two options. And if you wanted to get into startup investing and you didn't fit into those categories, you were pretty much out of luck. You had to essentially try to back things through Kickstarter or other ways, but you would never receive returns for those. That would always be as a donation or the purchase of a product. So with the launch of equity crowdfunding in Canada, it's finally possible for regular people like you and me to finally be able to invest in startups in a legal, safe way. So, with equity crowdfunding, essentially, we use digital technology to allow many individuals to invest smaller amounts, and then we pool all that using technology and make one larger investment in a business. To participate in equity crowdfunding, it's quite open. So you need to reside in a province that allows equity crowdfunding. So in Canada, not every province allows their residents to participate in equity crowdfunding. You need to be 18 years or older. And the minimum investment is $100. So you need to at least have $100 that you'd like to invest. But other than that, there aren't really any restrictions on your ability to participate. So it's really open for everyone. And given that this is the easiest way to participate, the discussion today is really going to be about equity crowdfunding and how you can become an equity crowdfunding investor, specifically with my platform, Equivesto. So, to go a bit more into detail about who can actually sign up as an investor on the Equivesto portal and invest in equity crowdfunding. So, our focus is all about inclusivity. You need to be 18 years or older, as I mentioned, and the provinces that we operate in are currently Ontario, Alberta, British Columbia, and Nova Scotia. We currently do not operate in Quebec, even though Quebec does allow equity crowdfunding, and there are platforms that allow equity crowdfunding in Quebec. So I would recommend looking at one of those, or waiting until we onboard Quebec, which hopefully will be sometime next year. And you need to have at least $100, which is the minimum investment on the Equivesto platform. Each equity crowdfunding portal can set their own minimum investments. And as well, the company seeking investment can also set a minimum investment. So while Equivesto's minimum is the $100, There are other platforms with a $500 or $1,000 minimum investment, and individual companies on the platforms may set their own higher investment minimums. So you're going to sign up and you want to get started with creating an account. It's quite simple. You go to our sign up page, give your email, create a password, and that's sort of the first step to creating an account. But there are a few more steps between that and investing in a business. And we do need to collect some personal information from you as the investor. And many people wonder, why do we have to collect this information? If you're signing up on Kickstarter, there's much less information that they need to collect. And the real difference there is with Kickstarter, you're essentially purchasing a product in advance, or with GoFundMe or Indiegogo, you're donating to a cause. And so in that scenario, because the money and the value is essentially traveling one way, you are giving your money to this company. There's not as much information that needs to be collected. However, with equity crowdfunding, because you are actually purchasing ownership of a business, and they're giving you those shares in return, we do need to collect some more information to confirm your identity, because we have to make sure you're legally allowed to be investing and know exactly who is investing in the business, as well as making sure that financially this is a fit for you. As I mentioned a little bit before the presentation began, the role of platforms, including Equivesto, and the reason that we are licensed as an exempt market dealer, is to help protect both the businesses and the investors themselves. And we protect investors. One way that we protect investors is to make sure that you understand the risks and potential rewards of investing in this. And we're able to give you some real financial advice that's custom and suited for you around these type of investments and whether or not they're a fit for your goals. You go on Instagram and Facebook right now, there's a lot of flashy, exciting marketing that's convincing you to do all sorts of stuff. It would be easy for someone without rules like this in place to create a really flashy campaign to convince people to give them a lot of money and invest in their business, but they might not mention, some of the not as nice things related to their offering. And so what's important for the platform is to make sure that we can spend some time and work with every investor to make sure that you're given the tools and all the education that you need to make informed decisions about your investments. So we collect the information shown on screen: your name, contact info, your address, date of birth, your social insurance number, which is entirely optional. This helps speed up the amount of time it takes us to confirm your identity, but you do not need to provide it if you don't want to. We collect your employment status, your marital status, any corporate information. On Equivesto, we allow individuals to invest as a corporation via their business, but many investors just invest personally, and so then you wouldn't need any corporate information. And then also we collect some personal financial details like your income and net worth, and we collect information about your risk profile. We also collect some additional documents depending on the account type that you apply under, but I'll talk about that a bit later. So as I mentioned, we collect this information because it's required by law. When you're signing up, we are doing an identity and a background check and a criminal check to make sure that you're not using our platform for money laundering or anything like that. And opening an account with us is similar to opening a bank account. We're a financial services company, and we have to ask all sorts of questions to make sure we understand who you are and all the details about your life. Also, as I mentioned, our role is to make sure that you understand the risks of investing in equity crowdfunding, and we can help you determine if investing in equity crowdfunding investments is the right fit for you and your goals. Even though the minimum investment is only $100, so it's designed in a way for everyone to be able to participate, it's still important for us and required by law for us to make sure that we understand your goals and your objectives to make sure that this is a fit. So let's talk about an example scenario. So this is a pretend person named Jimmy. He's 19 years old. He's married with one kid, and sadly, he's unemployed as a result of COVID. So his family has limited income right now, and he has some student debt. And so as a result of that, he has a negative net worth. And so he signs up deciding that he wants to invest, a bunch of money on Equivesto. As part of him signing up, we would talk to him, understand a bit more about his situation, get this information, and we would reach out to Jimmy directly and say, based on the information you've provided, given the investments are high risk and you won't be able to take your money out for at least 5 to 7 years, and the fact that you could lose your entire investment, we would actually advise him not to participate and not to invest via our platform at this time. If you only have a limited amount of money, given your scenario, and he's married with a kid that he has to take care of, we would highly recommend keeping that money and saving that for a sort of emergency fund or a rainy day, or using that to pay down some of his debt. So we would want to talk to him and make sure that he understands all the risks that were involved with investing, and sort of clarify that based on his scenario, it doesn't seem like equity crowdfunding would really be a fit for him at this time. Generally, just as a sort of rule of thumb, we generally do not recommend putting more than 30% of your total investment portfolio towards ultra high risk investments or anything like that. We want to make sure that people understand the risks, and they're not sold by the sort of sexiness of investing in startups and put in more money than they really meant to. And so we're really here to protect the investors and make sure that you understand everything before you're making your investment decision. So let's talk a little bit more about the different account types. So you've gone through, you've created your account, and now you've submitted your documents through to Equivesto. As part of that process, based on your responses to some of the questions, the system will automatically let you know what different type of accounts you are eligible for. So there are 4 different account types offered on the Equivesto platform. The first is the retail investor. So this is the account type open for everyone. No additional documentation is required, and it's the easiest and most straightforward to apply to. However, because it's the easiest and most straightforward and it's for everyone, the government has actually set limits on the maximum amount that you can invest in startups and high risk investments. And that is $2,500 per campaign and $10,000 per year. And that's set by the government in the rules, and that's not anything that we at Equivesto can change. But if you feel like that's too low, let us know and we can talk to the government about it. But it's a government set limit. The next type of account, so the one with the sort of next highest limits, is the eligible investor account type. So with this one, you have a bit more income, a bit more net worth, but you do need to provide some documents to support and sort of prove that you fit in this account type. So you need to provide, your last year's tax return, or a bank statement or statement from your accountant documenting your net worth. But this type of account gets you larger investment limits, so $5,000 per campaign and $10,000 per year. The next step up, just like what we were talking about at the beginning, is the accredited investor account type. So you've got the 200,000 or more in income, the $1 million in net worth, excluding your house. Again, you do have to prove that with the documents. So the tax return from last year or statement from your bank or accountant, but you have much higher limits. 25,000 per campaign, 50,000 per year. You also have access to accredited investor only deals, with which you would have no investment limits. So you could invest much higher amounts. And then finally, the last account type is the permitted client. So permitted client is the highest net worth individual that we have on the platform. Again, you need supporting documents for that. But if you have over $5 million in net worth, which could include your house in this scenario, You have no limits of any kind, and you can invest in anything you like. So in the process, you've signed up, you've given your information, and you've completed your forms. As part of that, your account has been chosen. We've reviewed all your documentation and approved it. The next step is to review the different companies. We have a whole range of companies on the platform that people can invest in. Also, this sort of sign up process is relatively similar at other equity crowdfunding platforms. Of course, they don't all operate in the same way as Equivesto, but they all have to follow similar requirements because we all are bound by the same rules, and most of us are all registered as exempt market dealers. So you'd still have to sign up, fill out the forms, provide the documentation that's necessary, get approved, and then you can begin investing. Once you review the different deals that are available for offer, you can quickly go through, and just a few clicks later, you can invest directly in those businesses. So this is actually what it looks like to get started. You would look at you'd be on the investors page of our website. You'd click sign up, and it would take you to this easy sign up screen here, where you just put in your name, email, and password to begin creating your account. Then we would go through and review it. So we can take up to 1 business day to review and approve your account. And if we need anything else, we may reach out and ask you additional questions about your scenario. Or if we have trouble confirming your identity, we might ask for just a copy of your photo ID, which includes your address, to confirm that. Once that's finished, you'll get an email from us with your investment limits. Next, you can actually browse the offerings. So this is a selection of some of the companies that are currently live on Equivesto, but we have several more as well that are live and launching soon. So when you review the offerings page, you can see some details of the campaign, who is eligible to participate, the amount of equity or investment that they're accepting, and how much or little you can invest and how many days are left in the campaign. Once you pick an investment that you like, you should take some time to review the full details of the campaign page. So the campaign page is going to contain all sorts of information about the company, as well as several documents, which might include financial statements, financial projections, shareholders agreement, and an offering document. We highly, highly recommend taking time to review these documents so you can understand the full details of the company and what you're choosing to invest in. Once you're ready to invest, you can click the Ready to Invest button, and that'll take you to the investment process. You arrive on a screen where it says to choose the investment amount. You can, with a slider or by typing in the number of shares, can easily choose the amount that you want to invest. Then the next screen takes you to some documents that you need to sign, and the little red flags take you to exactly where you need to go to sign that. It's all done digitally. Once that's finished, it takes you to the final screen where you provide your bank account information to pay for your investments. So we only accept payment for investments through what's called electronic fund transfer. So it's sort of like a more old school version of an email transfer, but it's a digital way to move funds. Essentially, by putting your information in here, you're authorizing our system to remove exactly the amount that you've chosen on the previous screen, and that gets directly removed from the bank account of your choice and placed in our segregated account where it's held for the duration of the campaign. Once the funds are moved, once you've put that information in, it completes the transaction. It can take up to 5 business days to move the funds from your account. So please make sure that you have enough funds in your account for the entire 5 days. Otherwise, you may be charged with a $15 not sufficient funds fee. And you'll get email updates throughout this process on the status of your transaction. We also have a few things in place to help protect investors, because with equity crowdfunding, we're essentially allowing everyone to invest in startups for the first time. We want to put a few additional protections in place so that we can really take care of investors and make sure that nothing is happening that that is planned. So in addition, to making sure we're moving funds in the most secure method possible, there's also a 48-hour backout window. So you've gone through this whole process, you've clicked invest, but then you've realized, oh, you know what, I changed my mind. I got too excited, but I shouldn't have invested. If you let us know within that 48-hour window, we will fully refund the money. We'll still need to move the money out of your account within that 5 days. We can't turn off that request for the funds once it's been activated, but we will fully refund the amount that you chose to invest with no fees related to that at all. Also, as I mentioned, for the duration of the campaign, the funds are held in Equivesto's segregated account, so they're not, given to the company right away. They're held there for the duration of the campaign. If the campaign doesn't reach its minimum funding goal, all of investors' funds are fully refunded to the investors. So even if the campaign's just getting started and it's only got, $500 of its goal, you don't need to be worried. You can still invest, and the money will only go to the company if they do reach their goal. Also, and very important to mention, when you do make your investment and provide your bank account information on that last screen, we do not actually record or collect that information. That is a sort of floating screen that's connected to our payment service provider who moves the funds in that secure manner. So we don't collect that information as Equivesto, and that's not stored anywhere where it can be accessed. It's kept entirely secure for you, and that's why you provide it every time you invest. That's the presentation. Thank you very much, and I'm excited to answer any and all of your questions.
Yeah, what happens if I'm fairly wealthy and 35, but happen to be unemployed right now as eligibility?
Great. So if we go back quickly to looking at where did I put it? Here, our eligibility. You're unemployed currently, so your income would be zero for this. It would also depend on your net worth as well. So if you have, let's say you have 200,000 in net worth or something like that, or 400,000. If you had enough net worth to be an eligible investor, you could still apply as an eligible investor. We would have a discussion about your current employment scenario, whether you have funds set aside to cover your living expenses and everything right now, whether you're planning on returning to work. Some individuals are they choose to be unemployed because they have enough wealth to live off of, and they generate enough return from their existing investments. So in that situation, just the fact that you're not currently employed is not going to restrict you from participating. But it's really about taking the time to have a direct conversation with you, or this pretend person so that we can feel comfortable that what you're doing and you are comfortable with your investment decisions, and you realize that these investments are longer term, higher risk investments. It's not the same as investing in a stock market where you can turn around and sell it whenever you like. Investing in startups, you're not going to be able to get your money out until the startup has what's called a liquidity event. So they're going to go forward and be listed on a stock market themselves and go through an IPO, or they're going to be bought by another company, or some other event like that is going to result in a sort of changing hands of shares. Unless that happens, the only way to get repaid is for that company to issue dividends to its investors.
So, on that vein, what kind of reporting goes to investors? And other than the annual general meeting, if you as an investor you invest in your platform, what kind of information do you get updated with?
Yeah, that's a really great question. So the required information to be provided from a company to its investors is actually dependent on the type of raise the company does. There's many different ways companies can raise capital from investors, and the government has tons of different rules based on which way they choose to raise. So if the company is choosing to go through one doorway, they'll have to provide audited financial statements. But if they go through another doorway, they'll only need to provide statements prepared by an accountant. But if they go through the most popular doorway, there's no legal requirements to provide statements. So because of that variability, there's no sort of quick and dry rule that's saying every company is going to provide the same level of reporting, even on the companies listed on Equivesto. The best place for investors to confirm exactly what reporting they're going to get is in the offering document, which is attached to the campaign page. The offering document is the most important document associated with a crowdfunding campaign, and that essentially outlines basically every question and every piece of information that an investor would need to know about the investment. It tells you exactly the details of the type of shares you're getting, the price you're paying, who else is already invested in the company, all the information about the founders. It's talking about the plans of the business, the risks of the business, any reporting that you're going to get. All of that information is in that document, and that is legally binding. So in that document, if the company says you're going to get, accountant prepared or internal financial statements once a year as part of the annual general meeting, then that's what they have to follow. At Equivesto, we highly encourage companies to provide investors with quarterly email updates, financial statements on an annual basis, and include them in the annual general meeting. That's really what we highly recommend companies to do. But again, make sure to check the offering document to see for sure what each company will be providing as part of their campaign.
I'm pretty sure there's some OSC rules around this. You can probably answer that. But there was a question here about somebody who was looking on your website, and they were hoping to find where they could just invest in a pool of companies on Equivesto's site.
That's a great question. Currently, it is not possible to invest in a pool of companies because the minimum investment is $100. That allows you to essentially make your own pool if you invested $100 in each of the companies on the platform. Our goal in the future is to create a pool where you could simply invest in that, and then the pool would invest in every successful deal on the Equivesto platform. But just so you know, setting up a pool in that way is actually setting up an investment fund. And there are specific rules and restrictions around setting up an investment fund that makes itself available to the general public. You need to provide audited financial statements on an annual basis, and the individuals who lead and control the fund have to have specific certifications, and the whole fund has to be registered with the government and meet all kinds of requirements. So it's not as simple as saying, I've just got a separate account here and you just put your money in there and I'll just put it in every single company on the platform. It is something we want to add, but it does take considerable time and effort to actually set up and register an investment fund.
So I got another question here. Do I need to create two accounts, one as an investor and one for raising capital, or can I just create one account and use it for both purposes if you need it?
That's a great question. We would ask that you create two separate accounts because when you're creating an account, the information we collect on the sign-up forms are very different, but each account is tied to an email. So you would need actually two separate email addresses. If you were looking to raise capital, we would recommend using your company email address. And if you're looking to invest, we would ask you to use your personal email address. But yes, we would ask that you have two accounts.
And that makes sense. So I've got another question here. What happens if Equivesto runs into difficulties? You seem to be the investor's only link to the company.
So that's a great question. We are the link to the company while the transaction is taking place. However, once the transaction has taken place and you've invested, we're actually no longer involved in that relationship. So once we sort of broker this deal, the company is given all of the investor information, and it's their responsibility to sort of reach out to you and provide you with direct updates on the documentation of the investment, including the offering document. You're actually provided with all the contact information of the company itself, their address, phone number, the names, emails, everything like that. So after the campaign is finished, it's the company's responsibility to take over that relationship and to provide those updates.
That's good to know, and rather than having to continue on because that would be seem like a risk for people.
Yeah, so we're trying to make sure that the entire process is secure and as protected as possible for the investors. So we have all kinds of insurance and policies and procedures in place to protect investors. But at the end of the day, once you've invested, if the investment goes through, the company hits their minimum and everything like that, you are now an investor in that company. And nothing that Equivesto can do can change or be involved in that investment. You're a shareholder and you have all of those documents yourself. Um, so that's information that you can actually download from the portal if you'd like to, including all the legal documentation that you sign as part of the investment. Those are actually your proof of investment. So they are countersigned by the company as part of the investment process. And so you'll have basically your purchase agreement for shares, which is called a subscription agreement. So you'll have your subscription agreement, you'll have your risk disclosure documents, and you'll have what's called a joinder agreement, which adds you to the shareholders agreement of the company. All of that information, which includes the company's information as well, is all something in that documentation that you can download.
And I took a look at your site. You've got, I think, 4 active campaigns going on right now. As an investor, what are the types of things I want to look for when deciding which ones are the right ones to invest in?
That's a really great question, Craig. So investing in startups, there's all sorts of different factors that go into making a decision, and people will sit and give you advice on what to look for and how to choose. And there are some important areas that you should look at, which I'll mention in a second. But the core piece of it is, honestly, it comes down to a gut decision that you as the investor have to make. People don't often always talk about this, but that is one of the really core pieces of investing. It's thinking about yourself and what you feel comfortable doing and whether a company feels right to you. If you're considering investing in a company but you don't have a good feeling about it, then I would definitely recommend not investing in that business. When reviewing a company to try to see whether that, to try to come up with that feeling of whether it feels good or doesn't feel good, I would really recommend, as I mentioned, reviewing all the details on the campaign page. So look at their current financial situation, look at what they've achieved so far, whether they've received investment so far or not, what their goals are for the future, how believable and achievable you think those goals are. Look at the risks that are outlined that are facing the business. Look at the offering document itself. Look at the shareholders agreement to understand how the business is controlled and sort of who has power there. Once you're sort of looking at all these kind of things, they should give you a little bit of a feeling inside of whether that, it feels good to invest or it doesn't feel as good to invest. We'll actually have another webinar in the future where Craig and I talk a lot further about how to actually pick out specific companies to invest in. But it really does come down to, how you feel about the business and whether it feels like a good fit for you. And at the end of the day, we specifically make the minimum investment only $100 so that people do have those options. Before, the minimum investment was, $25,000, $50,000. So the amount of pressure that would go into this one choice would be extremely high. With a minimum of only $100, it's just so much easier to say, you know what, I'm willing to take a chance on this business, or I want to take a chance on, these 3 businesses, because you have more choices and you're not putting essentially all of your money into one company.
Yeah, I guess you could spread a few $100s around on each of the companies if you felt that way.
Exactly. We actually highly recommend, if there's multiple companies that you feel good about, diversifying your investment across several investments. Rather than picking one company and putting all of the money you've put aside for startup investing into just this one business. That's really putting all your hopes and dreams on one company being successful. It's better to spread that across a few different companies, because then even if one of them is unsuccessful, the chance the other companies will be successful enough to make up that difference.
And that seems to be a lot of the big VC investor strategies at accelerators. They offer them almost every graduate a certain amount of money, just blank, so they get invested in everybody rather than trying to pick the one or two that'll succeed.
Right. Not to, you know, divert too much from startup investing, but if we look at investing in the stock market, they did a study years ago where they took the world's best stock pickers and they compared their investment choices with choices chosen by monkeys throwing darts at a dartboard. Uh, and the monkeys were more successful in determining the successful businesses than the highest paid stock pickers in the world. So as long as you are looking at companies and you're really able to make sure that it's, we've done our due diligence, of course. So a company's not coming on here where their idea is, I'm going to make a $50,000 sandwich and sell it for $2. So their expenses are super high and their profit is zero. All the businesses on the platform have been reviewed and approved by us. But as long as you've gone through and you feel comfortable with what the business is setting out to do, whether you feel that that is achievable yourself, uh, and you feel comfortable with the team who's going to be leading it and everything, then yeah, it's really a decision that only you can make.
What if I had the opposite scenario where I was doing a $2 sandwich and selling it for $50,000? By the way, anybody in the chat room who wants to buy a $2 sandwich for $50,000, I will start that business right away.
Well, exactly. There's a lot of businesses that come to us, and just so people know, there's hundreds of businesses that are applying to us all the time to raise on Equivesto that we turn away, and we say, you're not ready, or we think your idea needs some more rejigging. We try to be helpful when we're talking to companies. We're not just going to say like no, and then that's the end of it. We want to be able to provide good feedback, but there's definitely companies that it's clearly not the right stage, or they don't have they're not at the stage where they are really grasping exactly their business model or their goals. So for example, talking about your $2 sandwich for $50,000, I'd really need to understand what their business model and their plans, and whether they have any consumers set aside or anything like that. Given the $50,000 thing, as long as they've got like 100 customers lined up, or a couple hundred customers lined up, then it could be, even if it's only for a very short amount of time, it could be a very successful business. It depends on many things. But if they haven't got any customers lined up and their idea is just, I'm going to sell this sandwich for $50,000 and I know people are going to buy it, they definitely wouldn't be ready to raise on Equivesto.
Speaking of all of that, what due diligence does Equivesto do on the companies that are applying to fundraise?
Great question. So one thing that's really important to Equivesto, of course, is protecting investors, but is also removing some of the intrinsic bias that's present in how our investing system currently works. Um, if we were only to put forward companies that we personally would invest in, and those were the only companies we were going to put towards investors, just because of our own personal intrinsic biases, there'd be a bunch of really great companies that wouldn't be allowed to list on Equivesto's platform. So our focus is to make sure that the company is, legitimate, legal, operating properly. The team is well prepared and have the information that they need. And we also go through and make sure that their business plan is solid and it makes sense. They have a good go-to-market strategy. They're ready. They're organized. It's not some idea out of nowhere. To even apply to Equivesto, companies have to meet certain requirements, like they need to have a minimum viable product, or they need to already be operational with sales. They also need to be raising over the minimum amount of 25,000, and they need to be incorporated. So we take all that information and do a full due diligence review. We look at all the legal agreements that they've signed. We go through the shareholders agreement to make sure that there's the right protections in place for these new investors. We make sure that all these documents are properly prepared and organized. And then at that point, once we feel comfortable that it's a real investment, they're serious and focused on making it a successful business, they have a good plan, a good strategy, and the team is ready and sort of capable to go through and achieve, the next step in the business, that's when we believe they're ready to list on the platform, and that's when we would help them launch their campaign.
Thank you. That's great because there's a lot of questions about when, right? Uh, when to raise money. Handled a lot of that for your platform. So you mentioned the offering document,
Yeah.
and how long are they? And are there specific sections I should be focused on, or do I really pour through every aspect of it?
That's a great question. So the offering document is actually a templated document provided by the government. So the government has a template, and it literally says, section one, fill out this. Section two, fill out this. And so the variability in length really comes down to how much the company writes in two sections. One, which is their sort of business operations section, where they talk about what the company does, their goals, their competitors, all that sort of stuff, and two, the risk section. So that's where they can talk about the risks to the business, the risk to the investment, all that. Other than those two sections, the length is pretty fixed. The shortest I've ever seen one is usually between 9 and 10 pages. When they provide a lot of information about the risks in the business, it can grow to maybe 30 pages. But there is a lot of really good information in the document. I'm not going to recommend that you don't read it. I'm going to recommend that you do read it, and I'm going to highly recommend that you read all of it. Part of actually one little checkbox that you have to fill out when investing is that you acknowledge that the offering document has been provided to you, and you've had an opportunity to review it, and are only investing on the basis that you've reviewed that offering document. So I'm not going to say only look at section 3. When you're looking at it, I think you want to make sure you understand the risks involved. You want to understand the reporting, which is a question that we already talked about, Craig. Make sure you understand that. You want to understand the securities that you are buying, exactly the share and the share class, and what rights you have. So there's a whole section talking about the rights that you have as a shareholder. I would definitely make sure to fully understand that. And again, I would read the whole document.
Do we have time to talk about the different share classes that you offer?
Yes, we can. So companies are the ones who choose the share classes. So if you go on the stock exchange, you can even buy different share classes on the stock exchange. On Equivesto, again, there is that variability. So companies can choose to offer different types of share classes depending on their goals. So there's generally two share classes that are going to be offered on Equivesto, either common shares or preferred shares. Preferred shares uh, are usually they don't have any control or voting rights, but they're called preferred shares because they're usually given preference with in terms of payouts. So if you see something as a preferred share, usually there's going to be a guaranteed payment from the company. So they would say, we promise to pay this investor, X percent um, per year for the next X number of years. So that's sort of a preferred share. A common share doesn't have access to that sort of preferential payment. And that's sort of the base share. So that's usually the type of share that the other founders or most investors are getting. When you think about other angel investors or venture capitalists, when they're investing and they're investing for the long haul, they're usually getting common shares. So it's most likely that investing on Equivesto, you'll be getting common shares. Common shares share in the benefit of any dividends. So if the company decides to pay out dividends to all of its investors, you would get some of that. Also, if the company gets sold, you would benefit in the purchase of those shares as part of the sale of the company. And common shares can further be divided into voting common shares or non-voting common shares. Obviously, as the name implies, voting common shares are those who can vote and control the business via shareholders meetings. So they would vote to pick the board of directors who would then go and lead the business. Non-voting common shares do not have a vote. Given the size of the investments through equity crowdfunding, most people are putting in a few hundred or maybe $1,000 or $2,000 with equity crowdfunding. even if you invested the maximum retail investment, the $2,500 per campaign, given the number of shares and the size of the companies, even though they are quite new, um, even if you were given voting shares for your $2,500, you would have essentially no control over the business. Your vote would be so small, it would be 0.01% of the business would be the amount of your vote. And so we specifically make sure that all companies raising on Equivesto have clauses in the shareholders agreement to protect minority shareholders, whether they do have a vote or do not, because even those with a vote essentially have still no control over the business. So we want to make sure that there are rules in place, which we call tag along and drag along rights, which protect shareholders from essentially being screwed around by the larger shareholders of the business, which is usually the founders. So tag along and drag along rights essentially mean that it doesn't allow the majority shareholder to sell their shares but not sell everyone else's without you being included. So let's pretend a company shows up and they want to buy the startup. Without these clauses in place, technically that company could just go to the majority shareholder, 51% of the shares, and say, hey, we'll buy 51% of the shares and leave the other 49%, because then they'll still get control of the business. So that would, of course, enable maybe the founder and a couple initial investors to get their money out, but then everyone else, the 49%, would get stuck in the business and wouldn't have any opportunity to make a return on their investment. So the tag along and the drag along rights prevent this from happening. They ensure that if someone is being offered over 50% of the shares, they have to divide that evenly. So instead of, for example, oh, I'm going to buy 51% of the company and I'm going to buy all of the 51% of the shares from the largest shareholders, you would have to divide that 51% equally between all the shareholders in existence. So I'm going to buy 51% of your shares and 51% of your shares, and on and on and on. So it ensures that every investor gets treated fairly and has a potential exit. So that's the most important thing that we do to make sure that all shareholders are protected. And we do that no matter what type of share or company is coming on the platform. So if they're raising on Equivesto, they must have these tag along, drag along rights.
So as we record this in November 2020, mid-November,
Yeah.
the markets are a little bit crazy, up and
Yes.
down and roller coaster. The dollar seems to be very soft. Gold's not doing well. Bitcoin seems to be doing incredibly well. I mean, investing is all over the place.
Right.
So can you just take a minute to talk about one, shortly, the riskiness of early stage startup investment? Yeah, I knew you hit on it before, but I want to touch on that briefly again. And then the upside, why people are attracted to early stage startup investing.
Sure. So there's so many different factors that can lead to the riskiness of an investment. So one is the actual viability of the business that's underlying the investment in the first place. So is this investment going to go and make money? But the second one is also whether you'll be able to get your money out. So if you look at startup investing, not only are they smaller, younger businesses, but also your money is essentially locked in for a longer period of time. So if you invest in the stock market, you can go the next day and sell your shares. And the companies on the stock market are much larger companies that have been around for much longer. So when looking at this scenario, though, one thing that is actually quite important to keep in mind with the stock market is because it's an active market with the price changing all the time, the price change is not always driven. It's almost, I'm not going to say any numbers, but it's not always driven by an actual change in the value of the company that you're invested in or you're considering investing in. It can often be driven by emotional changes and things affecting other companies, but not necessarily affecting this company specifically. So if people get nervous and want to take their money out of the stock market because they're worried that something bad is happening, or there's an overreaction to what's going on with this company's competitor, the price can fluctuate quite aggressively. And for someone who's not doing sort of day trading or anything like that, that can cause some serious emotional concern, because you've got your investments and suddenly you see everything's just going like this, and you're really concerned. But the actual business, the strength of the business underlying it, may only be slightly affected, or might be affected in a positive way. But the whole impact of the market sort of emotional change can really affect the value of your investments. With investments in private companies, that's not going to happen, because there's no secondary market. People can't be trading all the time. And so when you invest in the business, you invest it at a certain stock price, and the stock price is not going to change until that liquidity event takes place. And so you won't go through that sort of emotional roller coaster as much as you would with something in the stock market. However, they're definitely on the higher risk side. If we're looking at the risk of investments, the underlying investment, you're looking at the risk that the value of it's going to change, or even the risk that it could go bankrupt and cease operations. So the risk of something going bankrupt and ceasing operations is much higher for startups and small businesses than it would be for a much larger company. But at the same time, the potential returns are different. If you're investing in a small business, there's so much space for it to grow and get larger and increase in its value. Whereas if you're investing in a large business, it's already gone through that growth from a small business to a large business. It already has that size and that market control. And so there doesn't exist that same amount of upside. If we're looking at overall categories of risk, I would say your lowest risk over here is like a savings account. Then the next would be government bonds. The next would be corporate bonds. Then you'd be looking at some combination of bonds and stocks, so a balanced mutual fund. Then you'd be looking at straight stocks. Then you'd be looking at sort of a whole combination of things over here in the riskier side. So you'd be looking at private real estate investment. You'd be looking at Bitcoin. You'd be looking at investing in private equity like this. These are all over here on that riskier side. But all of those things offer more potential for return. So you really have to weigh that difference. And also the liquidity, because that can also have a large impact.
And during times, uncertain financial times like we're in now, companies like Airbnb and Uber were born, and many others. So we're expecting a lot of that to come out of what were the COVID times, and getting in at an early stage on some of those companies would have netted phenomenal returns. But again, you might have to invest in a lot of different companies to hit one of those. So and there's a reason why startup investors invest in early stage companies, because although the risk is high, but the money is generally low.
So yeah, that's the benefit with the equity crowdfunding is the risk is certainly high, but the minimum investment here is only the $100. When the minimum investment was the $25,000, the $50,000, private equity investing like equity crowdfunding didn't make sense for the majority of the population. It was way too much money to risk in such an aggressive way. Like it really wouldn't make sense for people to do that. But now that the minimum investment is $100, it's a bit more of a choice. So instead of investing in a mutual fund where you don't really see any change in the value of your fund, and then suddenly it just tanks because the whole market tanks, and you're like, well, why did I just give you my money for 5 years? You have more options. I'm not saying take all your money and put them in something very high risk. That is the opposite of what I'm saying. I'm saying there's more choices available to investors, and there's more places that if you feel like you want to take on that risk, that you can do it in smaller pieces, in the piece size that fits what you want to do.
So I really appreciate you taking the time today. If people want to find out more about you and Equivesto, where do they go?
They can go to Equivesto.com. If you want to learn more about actually becoming an investor, you can go to equivesto.com/investors, or to just learn more about everything Equivesto related, you can head to equivesto.com/learn. You can also follow us on all social medias at Equivesto.
And we have one-on-one sessions with you this Friday. I just put the link in the chat room. I think we have 3 spots still available, so click on that before you leave. And thanks everyone for attending. Hopefully you learned a lot today. I did, and we'll see you all again soon. Thanks everyone.
Thank you.